Hi there. In this video, I'm going to be looking at the influences on financial management, more specifically, the external sources of finance. In this sort of part one of two, this will be looking at short-term debt. The next video will be looking at long-term debt. So firstly, we're going to look at short-term borrowing. So really, this is the, within 12 months, normally used to finance temporary shortages in cash flow, or to finance working capital. So the to help finance the day-to-day necessities of the business. Okay, now usually repaid within 1 or 2 years. Okay, and these sorts of borrowings normally sit on the current liability side of a balance sheet. However, if they're over 12 months, obviously they'll be in the non-current liability. So it depends on the term of the loan. However, these, as I said, these are for small or short-term necessities. Okay, so you're not going to be using a short-term debt instrument in order to purchase a new factory, for example. Okay, so what are some of the types of short-term sources of finance you can get? Well, we've got a bank overdraft. Okay, now the bank will allow a business or an individual to overdraw their account up to an agreed limit for a specified time. Okay, so it could be $1,000, it could be $2,000, it could be $5,000. Okay, so they can take out, withdraw money from their account up to that agreed limit, but it's only for a specified time. Okay, now this has got very low costs. Okay, there might be a small fee for the privilege of doing it. But the interest is also variable. So if you get it at a time when interest rates are quite low, then you're not going to be paying as much as if the interest rates were going to be a lot higher. Okay, so this is something that you really can't do every single month, okay, of the year. This is something that a business might do maybe once, twice, 3 times if they're desperate. Okay, because again, you're still paying interest on this. Now, the issue is if this is something that is being done every single month of the year, well, then the business needs to sit down and look at exactly, well, why do they need to keep overdrawing their account every month? Why are they always short that $1, $2, $3, $4, $5,000? What are some ways that they can avoid using a bank overdraft? And find ways of stopping that extra couple of $1,000s leaving the business, or find ways of minimizing that loss in the first place. Another type of short-term external finance is a commercial bill. Okay, now this is a type of bill of exchange, a loan, okay, issued by institutions other than banks. Okay, so it's not really some banks do now offer this, but generally it's done by institutions other than banks. Now, the borrower, so the business that is taking out this bill of exchange, this loan, they receive the money immediately, and they promise to pay the sum of money and the interest in one lump sum at a future time. Okay, in essence, it's a very big IOU. Okay, so the business will go to the institution, and this is generally for quite large sums of money. However, it needs to be repaid in a short amount of time. So this is something, depending on which institution is offering, anywhere from over $100,000 to minimum $500,000 as that form of loan. So if I were a business owner, I'd approach an institution and say, I need $500,000. They'll give me back. They'll give me the money immediately. However, they'll then say within 30 days or 60 days, I then need to repay that $500,000 plus interest, okay, whatever it might be, in one lump sum at that time. Okay, so this again is something that might be used for again short-term or very small necessities. However, this is something that larger businesses would do. Now, I know that $500,000 doesn't seem like a small necessity. However, when you're a large company, that might be the case. Okay? And then the final external source of short-term finance is factoring. Okay? Now, this is the selling of accounts receivable, okay, invoices. This will be in the current asset side of your balance sheet, okay? This is money that you're expecting to receive from other people, okay? So I'll use a diagram as an example in a second. However, this is selling those accounts receivable for a discounted price to a finance or a factoring company. Now, as I said, I'll use a diagram to make this one a bit easier. So, we've got the company. Okay, they're involved. We've got the customer, so another business. And then we've got the factoring company as well. Okay, now, the company sells goods to the customer and requests payment within 30 days. It could be 60 days, it could be 90 days. It's whatever their credit terms are. So, for example, I might be a company that makes red t-shirts, okay? And the customer might be a clothing store. So, those red t-shirts, I might be selling them to the business. Let's say I'm selling them, 100,000 t-shirts, and they owe me, let's say $200,000 for those t-shirts, okay? And I say, okay, you've got 30 days to pay me back that $200,000. Okay, you're extending them a line of credit. Just like banks extend you a line of credit and expect the payments, you extend another business or a customer a line of credit. Okay? And you say, give me the $200,000 in 30 days. However, something happens, and you might need that money straight away. You might need to pay a bill. You might need to pay something, and it hasn't been 30 days yet, but you need the money. So what do you do? Well, what the company would do is they'll go to a finance or a factoring company, and they will sell that debt to the company. I'll say to the factoring company, I'm expecting $200,000 from a customer, a business that I've sold these t-shirts to. I need the money straight away. What can you do? So the factoring company will buy that debt from me. Okay? However, I'm not going to get the full $200,000. I might only get 80, 90% of it. Okay? The factoring company pays me minus a commission. So I might only get $180,000. I might only get $150,000. Okay? But the bottom line is, I've received money immediately rather than having to wait for the 30 days. Okay? And then finally, the customer then pays the factoring company directly. Okay, so the customer then no longer deals with me, no longer sends me money, but they then pay the full $200,000 to the factoring company. Okay, so the factoring company acts sort of as an intermediary between me and the customer, me and the business, when it comes to collecting that debt. Okay. Now, the next video looks at still sources of finance in an external sense, but looking more at the long-term debt instruments. However, I hope this video on short-term external finance has been valuable. Thank you.